Hello and welcome to this week's economic update. Donald Trump visited the UK this past week, but rather than talking about his Brexit comments, we're going to open this week by talking about Trump's relationship with China.
6 months have now passed since Trump launched his first salvo in an attempt to reduce America's growing trade deficit. We know that each new tariff announcement is designed to up the ante. By design, it is part of a much larger plan to tackle what Trump perceives as the unfair competition US firms face abroad.
So far, there have been tit-for-tat exchanges between the US and China, and more recently between the US and Europe. This is a typically disruptive tactic in Trump's mission to achieve more favourable terms for America.
This past week, US trade representatives announced further tariffs of 10% on $200 billion of Chinese products. How China will respond is not yet known. The obvious retaliation would be to implement further tariffs on goods imported from the US.
However, China will struggle to match the new increased tariffs slapped on it this past week. Its imports from the US last year only amounted to $154 billion. This is deliberately provocative.
What tactics could China now play? A blanket tariff on all goods imported from the US would be a bold move, as they cannot source some of the goods elsewhere. Another option could be non-tariffs retaliation. They could make it more difficult for US companies to do business in China, or perhaps currency management or use alternative currencies.
Predicting the next step is difficult, as further escalations pose ramifications both politically and economically. Trump has also had issues with the European Union's retaliatory tariffs on US consumer goods targeted at key politically sensitive voting constituencies, such as Harley-Davidson in Wisconsin.
One thing is sure, we should expect more headlines as Trump struts the international stage, culminating in a meeting with Russian President Vladimir Putin on Monday.
This past week, European Central Bank Chief Mario Draghi expressed a positive, confident outlook on the health of the European economy during a well-delivered speech to the European Parliament.
In his address, he outlined ECB plans to hold the benchmark refinancing rate at 0.0%, with the first rate hike penciled in for summer 2019. The central bank also plans to halve the current monthly quantitative easing bond buying programme.
Draghi reflected on what he believes has been a successful, albeit unconventional programme. He suggests a similar effect equates to a 1.9% boost to growth and inflation between 2016 and 2020.
From a market perspective, the announcement bringing zero interest rate policy to an end and calling time on buying bonds is a clear signal from the ECB. They are confident that the intensive monetary stimulus programme has worked. Draghi described the policy as very effective.
It may seem strange to set out an intention to raise rates in the face of potential trade wars. However, when growth is set sustainably, this is exactly the time to start raising rates to prevent the economy overheating later and causing inflation to rise.
The ECB are not cutting the apron strings entirely. Whilst they are confident the economy is ready for monetary tightening, they are cognizant of the risks involved. The financial system has very much been supported by the ECB's actions for some time now, and cynics fear that by taking the stabilisers off, the economy may fall over. They are aware of this, and it explains their cautious attitude and actions, introducing tapering rather than stopping bond purchases straight away, and signalling well in advance their intentions to raise interest rates by what is a very small amount. Thanks for watching. See you next week for more Money Roundup.
And don't forget to subscribe to the True Potential Investor YouTube channel.